You're about to discover secrets that most people will never learn about money. Are you tired of living in debt and watching your finances crumble? It's time to turn things around. In this guide, we will show you how to avoid poverty and bankruptcy, how to make money work for you, and the strategies the rich use to multiply their fortunes. Stay until the end and learn what can completely transform your financial destiny. The difference between being poor and being broke is subtle but impactful. The poor are those who never had access to sufficient financial resources to live a comfortable life. The broke, on the other hand, had money in their hands but lost it due to mismanagement or lack of knowledge. It's like comparing someone who never had a car with someone who had one but crashed it and didn't have insurance. The poor dream of opportunities, while the broke lament the ones they lost. Most people fall into one of these categories, each with its own battles. For the poor, the daily struggle is for survival, seeking ways to increase their income and improve their living conditions. The broke often face the shame and regret of having lost what they once had. This difference lies not only in the bank balance, but also in the mindset and past and future opportunities. Poor people often develop remarkable resilience, adapting and making the best of the little they have. They are experts at saving and improvising, always looking for ways to stretch every penny. However, this skill does not always translate into financial knowledge, which is crucial to get out of this condition. Books like Rich Dad, Poor Dad by Robert Kiyosaki can be a valuable starting point. The broke, meanwhile, need to deal with the frustration of having had resources and, for some reason, not being able to keep them. This situation can be even more painful as it brings a sense of loss and regret. For them, the challenge is to rebuild not only their finances, but also their confidence. Courses on financial education and planning can be extremely helpful in avoiding the same mistakes. Life is not easy for either group, but the strategies to overcome difficulties are different. While the poor need access to opportunities and basic financial education, the broke need to relearn how to manage what they once knew, avoiding emotional and financial pitfalls. Here lies the importance of mentorship and support groups, where the exchange of experiences can be transformative. Moreover, society often stigmatizes both the poor and the broke, making financial and emotional recovery more difficult. Changing this perception is fundamental so that both groups can seek help without shame. Community support programs and solidarity networks can offer essential support as well as provide an environment for learning and growth. To get out of these situations, it is crucial to understand that knowledge about money is not a luxury but a basic necessity. Whether you are poor or broke, investing in financial education is the first step to transforming your reality. And it is precisely this understanding that paves the way for the next step, understanding how money really works and how it can be used to your advantage. Understanding how money works is fundamental to avoiding the traps of poverty or bankruptcy. Many people see money merely as a means to acquire goods, but it is a powerful tool for creating more wealth. Without this understanding, it is easy to spend everything you earn and never move forward. Practical examples, like learning to make a monthly budget, can be a good start. Financial education should be a priority for anyone who wants to have a stable and prosperous life. This includes understanding basic concepts such as compound interest, inflation, and investment diversification. Books like The Richest Man in Babylon by George S. Clason offer valuable lessons on ancient financial wisdom that still apply today. When you understand how money works, you can make smarter decisions. This means knowing when to spend, when to save, and, most importantly, when to invest. Instead of buying that new high-end phone, it might be wiser to invest in a professional training course that can increase your chances of a job promotion. Moreover, understanding money helps to plan the future with more security. This involves not only creating an emergency fund, but also setting long-term financial goals, such as buying a house or retirement. Budget spreadsheets or personal finance apps can be very helpful in this process. Knowing how money works also allows identifying opportunities to increase income. This can include investments in stocks, real estate, or even starting a small business. For example, by investing in stocks of solid companies like Apple or Microsoft, significant returns can be obtained over time. Another crucial aspect is the ability to avoid unnecessary debt. Understanding the difference between good debt and bad debt can be the key to financial success. Good debt is used to acquire something that will increase in value or generate income, such as a rental property. Bad debt is incurred to buy consumer goods, such as clothes or electronics, that do not bring financial returns. With financial education, people can transform their relationship with money and achieve the long-dreamed financial independence. It is a process that requires discipline, patience, and a lot of learning, but the results are extremely rewarding. And it is precisely this solid foundation that allows saving and investing wisely, a theme we will address next. Saving a part of what you earn is crucial for achieving financial stability and opening doors for investment. It is not just about saving for emergencies, but also about creating a fund that allows future investments. Imagine someone who saves 10% of their salary every month. By the end of a year, they will have a considerable amount to start investing. This is the beginning of a positive snowball effect. Investing the saved money is the next step to make it work in your favor. Unlike just saving, investing allows the money to grow and generate more money. The choice of investments should be made carefully, analyzing options like stocks, real estate funds, and even startups. Each investment has its risk and return profile, and diversifying is always a good strategy. The idea of a snowball effect in investment is fascinating. It starts small, but as compound interest and investment returns accumulate, the growth accelerates. A person who invests $1,000 per month with an annual return rate of 8% will see this amount grow to approximately $157,000 in 10 years, considering the magic of compound interest. It is the power of time combined with financial discipline. Saving and investing also require knowledge about where and how to apply the money. Besides traditional options like the stock market and real estate, there are alternative investments like peer-to-peer lending and cryptocurrencies. Although these can offer high returns, it is essential to be well informed about the risks involved. Investment courses offered by institutions like Harvard, MIT, or platforms like Coursera are great for beginners. A good example of investment is starting with shares of consolidated companies. Investing in companies like Coca-Cola or Google, which have a history of growth and dividend payments, can be an intelligent choice. Even with modest amounts, the important thing is to start and gradually increase contributions as confidence and knowledge grow. The key to success in investment is patience and consistency. One should not expect immediate results. The fruits of a good investment are harvested in the long term. Warren Buffett's famous quote, "The stock market is a device for transferring money from the impatient to the patient," illustrates this truth well. Staying firm in the strategy and avoiding impulsive decisions is fundamental. Thus, by saving and investing part of your earnings, you not only protect your future but also create a path to financial independence. This habit strengthens your relationship with money and prepares the ground for the intelligent use of debt, our next topic, which can be a powerful tool if well managed. Debt, when well used, can be a powerful ally in wealth building. Many people see debt only as a burden, but the key is to use it strategically to finance investments that generate returns higher than the interest paid. Imagine taking a low-interest loan to invest in your own business that has high profit potential. This is the essence of intelligent debt use. The first step is to differentiate between good debt and bad debt. Good debt is incurred to acquire assets that appreciate or generate income, such as real estate or education. For example, a student loan can be considered good debt if the education received results in a well-paying job. Bad debt, on the other hand, is used to finance liabilities that do not bring financial returns, such as luxury purchases or gadgets. A practical way to use debt intelligently is through business financing. Institutions like the Small Business Administration, SBA, in the United States offer loan programs with favorable interest rates for small businesses. This allows entrepreneurs to start or expand their operations without needing a large initial own capital. For real estate investors, the mortgage is a classic example of good debt. By acquiring a rental property, the cash flow generated by the rent can cover the financing installments and still generate profit. Over time, the property tends to appreciate, further increasing the investor's equity. Mortgage calculation tools, like those offered by Zillow or Bankrate, help evaluate the investment's viability. Another effective strategy is the use of revolving credit lines to seize investment opportunities in stocks or other financial assets. Experienced investors use low-interest credit lines to leverage their market positions, maximizing returns. However, it is essential to have a solid plan and market knowledge to avoid unnecessary risks. It is also important to consider the impact of compound interest on debts. Minimum credit card payments, for example, can result in a snowball of debt due to high compound interest. Therefore, strict management and full payment of bills monthly are crucial to avoid financial traps. Financial management tools, like Mint or Personal Capital, can be helpful in this process. Using debt intelligently requires discipline and planning. Financial education is again essential to understand the mechanics of interest and investment opportunities. Taking advantage of educational resources like Khan Academy's courses on finance or seminars from the Financial Industry Regulatory Authority, FINRA, can further enhance this skill. And by diversifying your investments, you ensure even more financial security, the theme of our next topic. Diversifying investments is a fundamental strategy to ensure financial security and stability. By spreading your money across different assets, you reduce the risk of significant losses. Think of a farmer planting various types of crops. If one fails, the others can compensate. Similarly, investing in multiple areas protects against the volatility of any specific market. The stock market is one of the first options that come to mind when talking about diversification. However, it is important not to put all your eggs in one basket. Besides stocks, consider investment funds, public and private bonds, and even commodities like gold and silver. Each type of investment has its risk profile and can react differently to economic conditions. Real estate funds are an excellent way to diversify. They allow you to invest in properties without having to buy a physical property. Additionally, they offer passive income through rents distributed to shareholders. In the United States, REITs, real estate investment trusts, are a popular option and can be acquired through brokers like Vanguard or Fidelity. Entrepreneurship is also a form of diversification. Investing in startups or opening your own business can be risky but also extremely profitable. Platforms like AngelList or Kickstarter allow you to invest in new ideas and emerging companies, further diversifying your portfolio and enhancing your chances of significant returns. Geographic diversification is another important aspect. Investing in international markets can offer protection against local economic crises. International funds, or ETFs, focusing on emerging economies, such as China or India, can be accessed through global brokers like Charles Schwab or TD Ameritrade. This not only expands your earning opportunities, but also spreads risks. Besides diversifying in asset types and geographies, consider different time horizons. Short, medium, and long-term investments help balance the portfolio and meet different financial needs. Short-term CDs, certificates of deposit, medium-term bonds, and long-term stocks are examples of how to spread investments over time. Diversification, however, does not mean randomly spreading money. It is essential to do a careful analysis and balance the portfolio according to your risk profile and financial goals. Using financial planning tools, like the robo-advisor from Wealthfront or Betterment, can help create a personalized and efficient diversification strategy. And mastering this art prepares you better for any financial challenge, including recovering from a breakdown, a topic we will cover next. Financial recovery after a fall is a challenging process, but absolutely possible with the right strategy. Firstly, it is crucial to understand what led to the bankruptcy or financial difficulties. Whether it was a bad investment, uncontrolled spending, or an economic crisis, identifying the root cause is the first step to avoid the same mistakes in the future. One of the first actions to be taken is to reevaluate the personal budget and cut unnecessary expenses. This may involve lifestyle changes, like reducing expensive entertainment or looking for more economical alternatives for daily expenses. Financial control tools like NAB, You Need a Budget, can help visualize where your money is going and where it can be saved. In parallel, it is important to rebuild an emergency reserve. Even if the initial amount is small, having a fund for emergencies avoids taking on new debts and unexpected situations. Automating monthly deposits into a dedicated savings account can make it easier to build this financial cushion. Another crucial step is to renegotiate existing debts. Many financial institutions are open to discussing better payment conditions, especially if you are in a difficult situation. Negotiating lower interest rates or longer payment terms can ease financial pressure and allow for quicker recovery. Platforms like Lending Club offer refinancing options that can be explored. Taking advantage of acquired investment knowledge can accelerate recovery. Even with limited resources, investing in low-risk, high-return options like treasury bonds or low-cost ETFs can help rebuild wealth. The key is to start small and be consistent, reinvesting profits to create a snowball effect. Continuous education is vital during financial recovery. Participating in online courses on personal finance, like those offered by Coursera or Udemy, can provide new strategies and insights. Additionally, reading books about recovery stories, like Principles, Life and Work by Ray Dalio, can be inspiring and offer valuable lessons. Maintaining a positive and resilient mindset is essential. Financial recovery does not happen overnight, but with persistence and the right strategies, it is entirely achievable. This process not only rebuilds your finances, but also strengthens your understanding of how money works. And with this solid foundation, it is possible to build a safer and more prosperous financial future, including the importance of spending less than you earn, our next topic. Spending less than you earn is a fundamental principle for anyone who desires financial stability. As basic as it may seem, this rule is often overlooked, resulting in debt and financial stress. Imagine someone who earns $5,000 a month but spends $5,500. The debt inevitably accumulates, creating a vicious cycle hard to break. The secret is to live below your means and always save a portion of your income. To illustrate, consider someone who spends $4,000 of their $5,000 monthly income and saves the remaining $1,000. This habit not only creates an emergency fund, but also provides capital for future investments. Saving $1,000 per month means $12,000 at the end of a year. This money can be used to invest in stocks, real estate funds, or even start a small business, like an online store. A practical strategy to spend less than you earn is to create a detailed budget. Categorizing expenses and setting limits for each category helps control spending and identify where to save. Apps like Mint or Enab, You Need a Budget, are great for this purpose, making it easy to visualize and control personal finances. Moreover, it is important to evaluate fixed and variable expenses. Fixed expenses, such as rent and utility bills, are hard to reduce but can still be optimized. For example, renegotiating the lease contract or looking for more economical energy plans can make a significant difference. Variable expenses, like entertainment and dining out, offer more flexibility for cuts. Another valuable tip is to adopt a minimalist lifestyle. This does not mean giving up everything, but rather focusing on what really matters and avoiding impulsive purchases. Maintaining a simple standard of living allows accumulating more resources for investments and ensures that money is used more efficiently. Financial minimalism not only reduces expenses, but also promotes a more peaceful and organized life. It is also crucial to understand the impact of small daily expenses, known as ant expenses. An honest analysis of consumption habits can reveal unnecessary expenses that, when added up, represent a considerable amount. Reducing these expenses can free up a good portion of the budget for savings and investment. A daily coffee of $5, for example, results in $150 per month, which could be directed to a financial application. Spending less than you earn creates a virtuous cycle where saved money generates more money through investments. This conscious financial behavior not only protects against unforeseen events, but also prepares the ground for bigger opportunities, like investing in your own business. And when reaching this point, the next question is how to use $100,000 strategically to multiply your resources, a topic we will discuss next. Imagine having $100,000 and the desire to make this money grow. A classic example is opening your own business, like a bakery. With $100,000, it is possible to rent a suitable place, acquire the necessary equipment, hire an initial team, and invest in marketing to attract customers. This initial amount can be the foundation for a prosperous venture if well managed. The first step in opening a bakery is to create a detailed business plan. This includes market analysis, identifying the target audience, defining the product mix, and financial projections. With a good plan, you can foresee costs and revenues, adjusting operations as necessary. Platforms like Score offer free resources to help entrepreneurs create robust business plans. Essential equipment, such as ovens, mixers, and refrigerated display cases, can be acquired with part of the $100,000. It is important to invest in quality equipment to ensure the production of high-quality products. Additionally, the store's decoration and layout are crucial to attract and retain customers. A welcoming and well-planned environment can make all the difference. Hiring a qualified team is also crucial. Experienced bakers, friendly attendants, and a good manager can elevate the quality of service offered. Regular training and a positive work environment are investments that reflect in customer satisfaction and the bakery's reputation. Resources like LinkedIn can help find competent professionals. Initial marketing should focus on attracting the first customers and building a solid base of regular patrons. Utilizing social media, local campaigns, and inauguration promotions are effective strategies. With $100,000, a significant portion should be allocated to these activities to ensure visibility and a good start. Tools like Google My Business and Facebook ads are great for promoting local businesses. Strict financial management is vital for success. Monitoring daily revenues and expenses, adjusting prices as necessary, and controlling operational costs help maintain the business's financial health. Management software, like QuickBooks or Xero, can facilitate this work, providing a clear and detailed view of the bakery's finances. With efficient management, the initial investment of $100,000 can be multiplied in a few years. As the bakery establishes itself, it is possible to expand operations, open new units, or diversify the menu to serve a larger clientele. Financial success does not come only from the initial capital, but from the strategy, dedication, and adaptability of the entrepreneur. And by understanding these nuances, it is possible to compare the returns of different investments, like we will see in the next topic about the comparison between 1.5% and 2%. Comparing investment returns and loan interest rates is fundamental for making intelligent financial decisions. Suppose you have the option to invest with a 2% annual return or take a loan with a 1.5% annual interest rate. At first glance, the investment seems more attractive, but it is essential to analyze the nuances of both scenarios to understand which is the best option. Taking a loan at 1.5% per year can be advantageous if the money is invested in something that generates a return higher than this cost. For example, if you take a loan to finance the expansion of your business and this investment generates a 2% return, you will be making a net profit of 0.5%. It is an intelligent use of debt that can accelerate financial growth. However, it is important to consider the risks involved. The investment return is not guaranteed, while paying loan interest is a fixed obligation. If the investment does not generate the expected return, you may end up in a worse financial situation. Therefore, careful analysis and a contingency plan are essential before making decisions based on rate comparisons. Using financial simulators can help visualize different scenarios. Online tools like Investopedia's Return Calculator or Bankrate's Loan Calculator allow you to enter different interest rates and expected returns to see the long-term impact. This helps make more informed and data-driven decisions. It is also crucial to consider the impact of taxes on investment returns. In some cases, gains can be significantly reduced after taxation, which alters the direct comparison between return and interest rates. Consulting an accountant or financial advisor can provide a more accurate view of how taxes affect your finances. In contexts where the difference between the return rate and the interest rate is small, like between 1.5% and 2%, the decision may depend on additional factors, such as investment liquidity and loan terms flexibility. A more liquid investment, even with a slightly lower return, may be preferable to a long-term commitment that offers less financial flexibility. Carefully comparing return and interest rates can avoid hasty decisions and ensure that your money works efficiently. The seemingly small difference of 0.5% can have a significant impact over time, especially when dealing with large sums of money or extended periods. Understanding these subtleties helps maximize financial benefits and make more strategic choices, concluding our guide on how to manage money wisely. Now that you know the secrets of the rich, are you ready to get off the financial tightrope and transform your life? What are you going to do differently from today? Will you continue complaining or take control of your financial future? Leave in the comments which strategy you will apply first. Subscribe to the channel and activate notifications to continue receiving valuable tips that can change your life. Are you ready to finally achieve financial freedom? The time to act is now.